The business model of REITs can be explained as follows. Use loans and unit holder money to buy good assets, lease them and collect rental, which a significant percentage will be distributed to unit holder. The model looks simple. Is it as simple and easy as it meant to be? Let's dive in and analyze further. Before we continue, a quick reminder. Using the Singapore 10-year bond as a reference, rates remained low for many years, dropped even lower during COVID. Many REITs took the opportunity of low rates to acquire and grow. Then the rates took a sharp turn and increased sharply. As REITs are leveraged, the speed and magnitude caused wreck, DPU cut, and unit price drop. At the same time, the rate from the Singapore saving bonds has been rising. Many risk-averse investors switched to SSB. Now, an important question is, what is our outlook for interest rate? Going up, staying high, or going down? What will be the new normal? This will have a major influence on our investing approach. For me, I prefer to assume that REITs can operate well at such high rates as we are having now. Here, I will explain the various components of REITs and how they relate to each other. Investment property are financed by borrowings and equity financing. The quality of assets will determine the gross revenue, net property income, and the long-term growth. The assets are also affected by revaluation, which will impact the gearing ratio and how much they can borrow. The REITs can also sell their assets. This can reduce their borrowings and be distributed to unit holder. How much they can borrow and the cost of that determines the financial cost. Borrowings affect the gearing, financial cost affects the interest cover. Another major cost component is the manager fees, which is a percentage of the asset value and MPI. Equity fundraising means more unit issue to share the distributable income. Together, they affect the distributable income and DPU. There's a lot of data given by REITs. We can actually go deep and comb them with each release and with each REIT. The key is what is your investing approach, your preference, and what matters. Let's use the same framework to summarize what to look for. Can the assets be able to hold their value and earning power? I view this as very important. How well do we know their assets? What are their strengths? Can gross revenue continue to grow? Are cost of debt stabilizing? Are gearing and interest cover within our comfort level? Will the manager cut their fees given the poor performance? Will there be fundraising expected? I'll be looking for a sign of DPU stabilizing or inching up. The most important question is, will the acquisition be able to translate to more DPU as they balance debt and equity financing? Will the assets prove to be good assets? It's not just about interest rate or having good assets leading to more income and more DPU. As REITs are leveraged and distribute most of their cash, each component is highly interdependent to generate that DPU. Because of the leverage, we have to be very careful that a bad situation can easily create a spiral out of control, making it difficult to turn around. Hence, quality matters a lot in REITs. I would prefer to be much more cautious. Total return for REITs are determined by DPU and its unit price. The ability to grow DPU consistently over a long period will have a significant impact on unit price. A rising DPU is an important metric in determining the quality of the REIT. Let's look at a few REITs. I covered them separately in my previous video, so do check them out. First, Frasers Centrepoint Trust. They have good shopping malls. They invest quite aggressively during the early COVID when the rates were low. Borrowings increased significantly, however DPU has been flat, partly because of COVID. Gross revenue has been inching up post-COVID. Retail should be back to normal. We need to see more revenue growth that allowed them to sustain the DPU. Next is Keppel DC. Similarly, they have been doing acquisition. Gross revenue has also increased. However, DPU has been inching down, which result in less growth in gross revenue. Borrowing and financial costs has increased quite significantly. DPU has been flat. Unit holders are not benefiting from the acquisition. Interest cover has been dropping as financial costs are increasing as a percentage of revenue. Parkway Life is one of the best managed REITs. This is a REIT I study and benchmark to. Their assets are increasing steadily, so are their revenue. Borrowing has also increased. As you will see in the next slide, their gearing is one of the lowest, interest cover is one of the highest. The number of units has relatively unchanged all this year. This is very rare. DPU has steadily increased all this year. I've plotted the interest cover to gearing ratio of a few REITs that have released their Q3 2023 updates and compare them to Q4 2019, the quarter before COVID. I've circled the 3 REITs I've covered earlier. You can see the changes in their position. I set the gearing at below 40%, interest cover at more than 3 times. Notice fewer REITs meet the criteria now compared to 2019. Do pause the video if you want to examine the chart. This is one important investing criteria given the rising rates and financial costs. As we are unsure what will happen, it's better to find REITs with a good buffer for both gearing and interest cover. Here's a sample list that reported their Q3 2023, showing how they are trading to their NAV per unit. Few are trading above the NAV. When the REITs market is down, many are fearful and pessimistic about REITs. This is a time to study whether there are good REITs that can survive and strive in such challenging time. Not all REITs are affected to the same extent. There will be a few REITs that will hold their value. One has to spend time to uncover these gems. Buy well, buy low. The lower the unit price, the lower the risk and the higher the rewards. The lower price also gives a better margin of safety. The situation is evolving. We may be wrong. We have to keep validating to make sure we are holding the right REITs for the long term. This is all I have today. Hope you find it useful. Do remember to like, subscribe and share your perspective. If you like chart analysis, do check out other videos covered on this channel. Thank you.